All right, ZKGM everyone. I hope you guys can hear me. I'm on my balcony right now in the tiny Airbnb in Cannes. Had a nice conference here, community. You guys knew we were here doing some BD. Released FV3 today as well, so I hope everyone is enjoying clicking on that kind of the work that Core delivered late at night during the conference. With me today are Megan and Chris. Megan is from a company we actually use internally in Premium, Franklin, and Chris is doing some actual DeFi Summer stuff as well. So Megan, go ahead and give a brief introduction about yourself and your company, if you would, please.
Awesome. Yeah. Hey, guys. I'm Megan. I'm the CEO at Franklin. We've been around for 3 years and really are passionate about helping companies be able to operate on chain. We do that through offering a platform of financial services. So things like payroll, bill pay, revenue management, all the kind of nuts and bolts that companies need to operate their businesses. We can help them do it on chain. So great to be here.
Yeah, thank you so much for being here. And Chris, please enlighten us on Summerfi and DeFi Summer.
Yeah, of course. Yeah, so I'm Chris, CEO of Summerfi. We've been around since kind of like 2021, although dated back to like 2019 inside the Maker Foundation as the original front end there. But most recently, we've launched a lazy summer protocol, kind of second generation yield optimization protocol, uses AI to optimize lending positions across the market to offer kind of the best risk adjusted return for users effectively. So the easiest way to kind of earn on your like stables or ETH.
Okay, makes sense. So mainly influx coming from stablecoins that you guys deal with, or more crypto native assets as well?
Primarily stables, like that's stables and ETH. So USDC and ETH are the two like highest deposit assets, kind of as you see as well through like kind of the lending space in general, kind of on Ethereum and some of the main L2s and so on. But yeah, we've got USDT on there as well, and EuroC as well, which hasn't had as much take up as we'd have probably liked or thought maybe it would have done, given kind of like the kind of growing adoption of crypto in like kind of Europe and so on. But yeah, primarily USDC and ETH, they're the two main ones, still dominant tokens.
Yeah, to be honest, like I'm European myself, but I don't hold any like Euro stable coins at the moment at all. But to be honest, like I have indeed been thinking about doing this. We have a bunch of employees in Europe as well, and to be honest, like I've taken a 10% hit on my salary in the last year or so, right? The US dollar going down respectively. So actually, it might make sense for companies to have both positions. And Megan, what do you see happening here? Because you must kind of have some insights into the back end of many like crypto companies. Do you see any factors be worried about this, or?
Yeah, I mean, well, we see like our target market is primarily US based companies, but we see a lot of pain for like, the US dollar around the globe. One of the best, like maybe like, biggest product market fit in crypto is using stablecoins for international remittances. And the fact that USD has tanked so bad has kind of put some pressure on that. We did actually a couple months ago just enable Euro stablecoins on the Franklin platform for this very reason. But yeah, we haven't seen it take off quite as much as like maybe I would have thought. But I think it's just, slow like ramp time. But yeah, I mean, we're really excited about yield at Franklin. We ran a survey at the end of last year to see, just to understand what our users wanted. And the number one thing that they wanted was the ability to earn interest on their payroll treasuries. And so, a lot of companies have money that's, if you're using a TradFi payroll processor, they're making money off the float. They're holding your cash for long periods of time. You can obviously speed that up with smart contracts and stable coins, but you still have the issue of money sitting there, not really doing much for you. And so I was so excited to get to meet Chris a couple months ago and the rest of the Summerfi team to be able to integrate their lazy vaults into the Franklin smart contracts so that our users could actually be making money off of like running bill pay, running payroll, stuff like that. So we're super excited about yield and that space and what Summerfi like in particular has to offer.
Yeah, so just to kind of summarize this for some of the listeners, because you threw in a whole bunch of technical jargon, I think for them, I think this was like every single founder wants to, just like a regular user, like earn yield on the company funds, not because they're keeping that themselves, but just because you want your runway to last longer, right? Like if you just raised 5 million from VCs, you ideally want to make sure that you're actually obtaining yield on that 5 million as well to make your runway last longer. And initially, to be honest, like when we did our first race with you, I was kind of disappointed that space was actually very underdeveloped. I thought initially that might be some like the most developed space in crypto to expect as well. Founders are smart people, right? They're not going to leave that on the table, but felt that portion lagged behind a little bit. And only since the last year, I've really seen it like come live in multiple products. Is there a specific reason for that? Like, is it just that like took a while to implement from a technical perspective, or maybe were there certain legal hurdles why we saw the kind of yield space for companies be maybe a bit behind?
Well, I think Chris is the expert here, so I'll let him answer. But from my perspective, I would say like earning DeFi yield has kind of historically been something pretty scary. And when you're managing like a big balance sheet for a company, is it gambling? Like, is it worth taking the risk? And you have to actively manage that in a way where you wouldn't normally need to if you were just sitting in you had your cash in a bank account. But I think like one of the ways that Summer approaches this is like really interesting through like your risk management process, and got us to a point where we felt comfortable being able to integrate for, like lower risk, higher yield DeFi. But Chris, I'm curious your thoughts.
Yeah. I mean, I think you summed it up really nicely. Like it was really risky. I think there was two types of like big hurdles effectively to the yield space. In our opinion, like prior to Summerfi, there's been one or two others now that have come out kind of doing similar things as well in the last month or so. But effectively, yield aggregators kind of pre-25 really were primarily token farming aggregators. So you were primarily distributing assets into different protocols, different chains to farm airdrop tokens, to farm tokens, immediately dump them and boost your yields that way. And that's super scary. That's kind of like real DeFi natives, kind of DeFi degen kind of approaches and so on. Or on the other hand, if you wanted to kind of lower risk, there was a lot of manual management going on. APYs were going up and down. You had to continuously kind of monitor your deposits or accept extremely like much lower yields if you just wanted to park them in one place and leave them and forget about them. And we're talking yields there sometimes like 60 to 70% less than what you can get by actively managing them. But most companies, most people don't have the time to actively manage, but don't want to be taking on the kind of the additional risk of just farming maybe brand new protocols and so on. So at Summerfi, as Megan alluded to, we actually have a completely independent risk manager in Block Analytica. So they manage all of the risk when it comes to kind of like maximum exposure to any one market or protocol. Like the maximum some can go into there as part of the total TVL and so on. And we have the concept of a lower risk and a higher risk kind of vault strategies as well. So if you want to, the lower risk ones have no like peg risk or swap exposure and are typically very, very liquid protocols to lend into. And the higher risk ones may have kind of some additional risk. It may have peg risk, but maybe depositing tokens into other kind of USD based tokens if it's USDC, for example. And there's always then the kind of peg risk on taking on that other token. And sometimes slightly more liquid protocols, things like Maple and so on that have withdrawal queues, or like the Fluid Light ETH leverage vault, for example. There was like a 7-day window to get the staked ETH out again without paying, kind of taking additional price impact and so on. I'm swapping it out. So yeah, I think really it's kind of a grown up yield product for kind of like as we move into this much more kind of grown up DeFi space in some ways, and do less token farming and more like actual yield for companies like that are using Franklin and so on, that just want to earn a yield like you would if it was in a bank account or whatever. Makes
sense, yeah. So on the side, of course, like an EtherFi card, and there I think you can actually have your funds in the liquid USD. Is that one that has like a withdrawal queue? And if so, like how do they accomplish like that I can pay all the time while there's still like a withdrawal queue going on? Is it like a sector of market makers as well, or maybe like traders that maybe directly settle for when companies or users want to do a payment and they take on that risk? Or is it like, are you guys always directly almost settling on chain when like a payment is being performed and immediately liquidating the USDC and such?
Yeah, I mean, for us on the financial operations side, we're, like we have like the liquid kind of like payments area, and then we have the treasury. So the treasury, which is, not being used every day for you know, like one-off bill pay or things like that is what would be earning yield. Yeah, and we like everything is 100% on the crypto side of Franklin, at least managed by the user. So, you know, we're non-custodial, it's smart contract based. So it's really kind of however they want to be doing it. If they want to be liquidating their yield position and then paying bills or manage it some other way, it's really flexible in that way.
Makes sense. So that basically means like it is actually settled on chain immediately. Like you don't have an intermediary in between there, but when a company liquidates, it actually needs to be immediately liquid.
Yeah. I mean, I guess if we, the intermediary is the smart contract, I guess, which is kind of cool.
Yeah, that makes sense. Is it kind of the same that you see as well, Chris, with like people that leverage like Summerfi as the DeFi backends? Are they like immediately setting on chain, or is there like a layer in between of maybe winter mutes and such that are like settling for like other companies?
You mean the ones using Summerfi in that point, or?
Yeah, exactly. Maybe third-party companies using Summerfi as like a DeFi backend.
Yeah, so we've seen a couple of integrations of other DeFi protocols because there is no withdrawal delay whatsoever. It's all like kind of what we call atomic. When you make a withdrawal request within that same block, obviously the money is back in your wallet. That isn't the case for many DeFi like yield aggregators and so on. That there is a kind of withdrawal request, withdrawal queue, and so on. Particularly when they've got kind of different assets within the same bucket, you have to understand kind of what the share price relates to the underlying assets and so on. But with Summerfi, we've seen a number of integrations because it is that atomic thing. So like we've also got some users that are using it, I think, to arbitrage rates. So they use it, they hold all their funds in Summer. And we literally see on the analytics sometimes like $1 million can be withdrawn and then 2 blocks later redeposited again to almost arbitrage out some sort of like deal, I guess, somewhere. But they're almost using Summerfi to make the best yield while not using those funds for something else. And yeah, it's pretty fascinating. We've got some other integrations ongoing at the moment with some like kind of DEX exchanges and so on, where the assets, when they're not being used to swap, will be earning the yield from Summerfi, the lazy Summer vaults, for example. So as a LP into like these DEX protocols, not only are you earning them the trading fees, while those tokens are not being traded, they can be earning the yield from Summerfi because it's atomic. It's effectively they can just be pulled in at the moment the swap is needed, kind of like withdrawn from the vault, used for the swap, and then if it's on the other side as well, deposit it back into Summerfi again for the other side of the pair if needs be. So it's a really nice way for multiple different use cases to continue to earn even better rates and supply DeFi liquidity around the network where it's needed most.
Gotcha. So that's a sort of just-in-time liquidity where the pool normally doesn't have that much liquidity in it, but when a large order comes in, you route that.
Kind of, yeah, but it's more the fact that when they do have liquidity, that liquidity, although it's there, kind of can be there within the smart contract. It can also be like, for example, deposited and be earning in there. So although the liquidity might not be then sat in that contract at any one time, it's there to be pulled into the contract within the block the trade is made and so on. So if the pool is earning say 2.5% APY on trading fees annually, they can also be earning 7% while the funds are not being used for trading and so on. But the 100% of the funds are there to be used for a trade if a swap trade comes in and so on. So it's a way of earning the effectively the lending aggregation yield on the lazy vaults, while also using the APY and not giving up the liquidity for the exchange at the same time. So instead of us using the liquidity within Summer to provide that kind of just-in-time liquidity, it's actually the exchanges that using Summer instead. So it's a really nice use case. Again, possible because it's non-custodial, because it's atomic, because there's no middle persons in there or anything like that. It's all kind of single block execution, and the money is there.
It's so cool. I'm kind of curious, Chris, because you've been around the space for so long and like at Maker and stuff like way back in the day. I'm curious to see like how have you seen like the market and the tech just evolve over the last like 6-7 years? I know you said that we were moving beyond like the kind of like token farming maybe of like 2020, but I don't know. I feel like this product couldn't have existed like 4 years ago or something. How do you think it's changed?
I think so. I think the product could have existed, but it wouldn't. You just wouldn't see the rebalances happening like you do today, for example. So at the moment now, there's like I think over 30 or 40 different markets kind of being used. Typically, a vault would have maybe 3 to 4 markets maximum exposed to at any one time. But if you look back in like 21 and so on, and again, the protocol only uses kind of like top tier proven DeFi protocols and so on, kind of approved by the risk manager. So like there just wasn't that many, I guess, protocols that were that trusted beyond the likes of like kind of the Maker savings rate, Aave, Compound, probably like the first version of Euler back in the day, and so on. But yeah, like that's where now that we've got more and more of these protocols all doing something kind of a little bit different to provide good yields and so on. But when you talk about how it's changed, yeah, I mean, 2021 it was like full blown kind of like yield farming on tokens. Like we had all the kind of vegetable tokens, like kind of 2020, 2021, where everyone was farming a different vegetable every week and so on. And
Did you have a favorite vegetable?
Sorry?
Did you have a favorite vegetable?
I mean, the Yam Finance one, that was, I think the first one that launched was always the one that stuck in my head. It was such a great thing. And it just like DeFi Twitter back then as well, crypto Twitter in particular then was just like crazy for all this stuff. And that one meme that was going around constantly, like it's like, it's not much, but it's honest work of the kind of the farmer in the background and so on, was just like the perfect thing, I think, that summed up kind of crypto and DeFi back then. But yeah, we were chatting just beforehand before the call as well about the kind of how far we've come in, like now where we have these fully on-chain DeFi solutions that unfortunately didn't really exist and there to be able to compete with like the likes of Celsius and so on in 21 that talked about it all being on chain, talked about it all being safe and secure and so on. And I think a lot of us within the kind of the industry and so on, we could see the kind of risks that were in place there. We knew full well that they weren't like it wasn't always like fully bad. Like they had Maker vaults open, that was all public and trading. You could see them like leveraging up and so on. And yeah, like they were just kind of
how that turned out. Yeah.
Exactly. Yeah. I was trying to pick my words carefully to not like say it nicely, but like they were like ultimately just tricking people into like the safety and security of kind of using the blockchain to prove that your funds were safe and secure at all times and so on. And just doing what the traditional banks and stuff do every day anyway. And hiding behind kind of like black boxes and things like that where you can't actually track anything. And like that's the one thing we pride ourselves on at Summer, like we always have done, even back in the Maker days and so on. Like everything is so transparent. Like you want to see where every single kind of like way is, or it's like sent and so on. Like you can see that, you can account for it, that like there's nobody getting special deals, there's nobody getting kind of backdoor access or anything like that within DeFi. And yeah, I think it's come along so far. And I don't think it would be hard necessarily for another like centralized like kind of product like Celsius stuff to maybe come along, but I think they would struggle, I think, to maybe get the kind of approval a lot of people within crypto space now that they unfortunately got, and they kind of got the validation at the time, and they obviously grew to like huge amounts of money very quickly. But now we're starting to have on-chain products and so on, and hopefully as well in reality, like regulations will come in and allow more of these kind of like on-chain products and blockchain technology like to be used in actual forward thinking like Web 2 apps. And you see institutions doing the kind of the custodial Bitcoin ETF and ETH ETFs and so on, which is kind of a win on one side, but at the same time they're not really using the blockchain for anything that it was primarily to be there to be used for and so on. It's still off-chain custody and so on. So yeah, like hopefully that's the next step, that we start to see some on-chain ETFs and things like that, and actually making use of the technology we've all built over the years.
Yeah, I think we're actually quite, or at least this week, one step further, right? With now the Robinhood chain and same on Solana with Summerfi, right? I'm not actually sure what we are trading, because we're not really trading stocks, right? There's some like derivative that's priced similarly, and I assume that you can probably liquidate that for like the US dollar equivalent value of the stock, but I don't think you get like voting rights, dividends, etc. But at least like it's a step forward, right? Because I can imagine now indeed that we might have like more assets accepted in lending markets and such, right? That I can actually move my like stocks portfolio over on chain, take out loans against that directly, and have a bit more to do with that. Like, how do you guys see that? Is this something you're like extremely excited about, or is it something we maybe have seen before already, but actually didn't catch on before?
Yeah, I have mixed feelings about this. I have like a past history working in equities brokerage. I was working on Wall Street when the GameStop short squeeze happened at a broker. It was so exciting, and was part of a initiative actually at DTCC and NSCC, which are the stock settlement corporations self-regulatory bodies in the US around like how can we be trading stocks on chain. And actually the first company that was really like a leader in this was Paxos, where they created these order books where you had these TradFi brokers, like the company I was at, testing some trades on chain. And so there are like a lot of issues that come along with that, namely your order book is public. That's something brokers like to kind of keep secret and stuff like that, so that they can, there's a lot of wheeling and dealing around selling order flow underneath the hood. I think like the Robinhood chain is like, it's nice in the way that there's some recognition by, this big retail broker that blockchain technology is like useful. It reminds me a lot of these like financial products called ADRs, which are basically like ways to put assets in a different system. So like, like on the Brazilian stock exchange, you could have these ADRs, BDRs, which are basically just like a bank issuing an underwritten stock product where, like you said, you have no access to voting rights. You don't really have the same access to dividends. Like it's basically the bank putting up some money saying, yeah, this is like our pot of money. And, that looks like a Tesla stock. It's not like that interesting. Like it would be cool, like Chris is saying, to have ETFs on Ethereum, not like an Ethereum ETF. But, the counter argument is it brings in more institutional money around like the periphery of like crypto, which is, good for security, good for like the brand. But is it that interesting? I don't know. I want more companies to be operating on chain, and I'm not totally sure that hits the mark yet, but it's a nice try.
Yeah, I was thinking if we're maybe going to see like algorithmic stable coins backed by Tesla stock, right? And like some crazy system where there's some like basis trade being done on that, dividends included, maybe with like a combined like ETF portfolio behind it, right? To manage risk. But
that would be wild. Yeah.
Yeah, like maybe it opens up like this really weird new financial sector where all of our weird like DeFi experiments, where previously we were like backing it by vegetable tokens, so the underlying technically was like worthless. We now can actually back it by real companies, real stocks, and then we see indeed like the kind of the next generation of finance come from this. Maybe you have thoughts on that, Chris.
Yeah. Well, just kind of somewhat related to that actually is like when I joined Maker back in 2018, like I was in the kind of digital wealth management space then, trying to like kind of digitalize wealth management and so on, which is kind of how I saw kind of crypto and DeFi kind of taking that next step. But yeah, when I joined Maker, obviously they were in the process of building multi-collateral DAI, and like there was a lot of talk then about real world assets and so on, and real world assets coming on chain, and it being real world assets that back DAI. And so on, which is kind of the case. But from my point of view, yeah, I was super excited at the idea of there being kind of on-chain ETFs and so on, and then people being able to borrow against the ETFs without sacrificing and selling the ETFs and so on. We had a lot of people that we saw in the wealth management space, and particularly in 2018 or 2017 when Bitcoin was really starting to kind of like to rally and things like that, and ETH as well and so on, and people withdrawing from their ETF to buy Bitcoin and so on. And for me, when I like kind of first discovered Maker, first started hearing about Maker, like the idea that you could have that these people could have these ETFs on chain. Back then, Maker rates were like 1.5% or 1%. I think it was a big deal when they went to like 2%. I think, and like, oh, it's getting a bit expensive on chain and so on. Like it was like 0.5%, 1%. But these ETFs were making pretty solidly 6, 7, 8% a year and so on. And it was like if you didn't have to sell them and so on, and like you never know like when you can sell them, like you're selling them and it's like it's whatever the price is at the end of the day, you buy it again whatever it is the next morning and so on. But if you could just borrow against it, and then again you're putting all these real world assets, these real underlying stocks and so on back into that's backing DAI. For me, that was like how like DAI or USDS now like had real strong hypergrowth and so on, because there's obviously billions if not trillions of dollars in ETFs and so on, and I think we are kind of getting there. Like USDS is heavily backed now by a lot of like off-chain real world assets and so on. I think they're like working with BlackRock and so on, like bringing assets on chain. But yeah, it's hard. I mean, I think like talking about the Robinhood ones, like backed finance, like started to bring some of the stocks on chain and so on. I think they did a pretty good job. They obviously haven't got the brand that Robinhood have got. So when Robinhood stand up and say, hey, we're bringing stocks on chain, there's a lot being written about it, like it's the first time it's ever happening and so on. Megan, you talked about like Paxos and so on, but yeah, Paxos backed, like we've kind of been here. We've tried to do it. It's not really got the adoption, but it's not reinventing anything either. I think it's obviously bringing it on chain, but there's not a huge amount yet that can really be done. Like they're not accepted into lending markets or anything like that. So yeah, and I think it's also going to be the issue once it is potentially accepted into like lending markets and so on, then the regulatory stuff starts to go out the window, where like professional people, you can't like, there's no like meant to be like shorting or like going long or like leveraging and so on. Suddenly, like with all these lending markets, it's almost powerless to stop it, and so on. So that would be interesting to see if they actually do get adopted. I think it's going to be a little bit of time before we see a lot of money flowing into the stocks on chain, because like you said, they're just derivatives of it. Like what is it really? And I think it's going to be a somewhat mini experiment to start with. But yeah, I mean, it's super exciting. I think it goes back to my earlier point about it's DeFi and crypto growing up, I think, and becoming that little bit more serious. So yeah, I welcome it.
Yeah, I'm thinking we're going to maybe get like a brief period where regulators are lagging behind and some developers will come up with some of the most insane products. I can imagine some derivative that's like Tesla stocks hedged by a polymarket bet on if Trump and Elon are going to make up again or not, right? They just get these like really funky, weird, sophisticated instruments that only make sense for like 6 months in crypto before all of this leverage is taken out again.
Yeah, exactly. Yeah, and I think we've seen some of the innovations in crypto and so on, like, yeah, do so well, and then like before we know it, there'll be pendle markets and so on, probably with like Tesla stocks and things like that, where suddenly you can get some fixed rates and so on, and how does that actually impact the market, and so on, and things like that. So yeah, I think it's gonna be fascinating to watch and see.
My biggest fear, to be honest, is that actually like, if you look at those like historical graphs when like more financial instruments were introduced over time in the markets, like since the 60s, that we see a volatility only increase with time, right? Like the more sophisticated things we can actually do, the more leverage we can add, the more we actually see the markets bounce up and down. So my biggest fear is that this like actually next unlock for regular mom and pops might actually be negative overall and allow like a whole new class of leverage and volatility into what previously was maybe like a bit of a safer asset class, right? Like ETFs, S&P 500 and such, and then we're now going to crypto-fi them. As a developer, I love seeing it, right? Because just like endless possibility, right? Like you do whatever you want. But I'm wondering, like indeed, like if for a brief period of time this will be a net negative and maybe like an unsafe thing to do.
Yeah, I mean, I think if we like compare, we'll go from like YAM token to like these long tickers like TSLA, POLY, whatever. Like, I think your point is right. Like the more you like derive an asset and kind of manipulate it and repackage it, the much more dangerous it is, the much riskier. And like, that's not great for like a normal retail investor. And like in the US, we have all these very stringent rules around, the kinds of financial products that people can invest in, because like, basically the idea is like, if you're not already wealthy, you shouldn't have access to some of these wealth generating kind of assets. But it's also true, there's some level of like understanding that you should have when you're investing in things. And that's why crypto is so exciting for US based people, because you can just do whatever you want. So super high risk, high reward. I think if we go back though, like, the current financial system is risky. Like during the GameStop short squeeze, the amount of time it took to settle stocks and the increased level of volume created like a system collapse almost, where the net capital requirements required by brokers were so high they had to halt trading like multiple times per day. People can't get out of their assets. And if we just kind of, this is why we should have just stocks on chain, because if you decrease that time to be within a block, it's settled like you can with lazy vaults, that eliminates a massive risk vector. It actually deflates the amount of float needed and capital requirements and things like that. So yeah, the more derivatives out there, the dangerous. But if we can just get the fundamental asset on chain, that's going to like really transform the financial system. So that's kind of what I'm hoping for. Just bring it all on chain. Yeah,
that makes sense. And at least for me, like I went into crypto because I thought like the EVM, like global world computer, it has a sort of purity to it. It's almost like a platonic universe of perfectly described like mathematical financial instruments. I'm guessing now it's too complex, to be honest, for like humans to truly parse, right? Like there's so many DeFi protocols that are intertwined with each other. Sure, the Solidity code is out there. Technically, you could build a perfect mental model of DeFi, right? Like the code is out there, but I don't think feasibly a human could. But I'm guessing like with AI, right now we might be actually entering an era where indeed like the full financial model could actually be entirely understood, and maybe AI would be able to tell you, yes, like the risk on CX Tesla wrapped hedge denominated is this percentage. So I'm very curious to see how that will back out. Because you mentioned, Chris, that you guys with Summerfi use some AI. Like how extensive is that? Do you use them on the back end?
Yeah.
Or?
Yeah, so the keepers that rebalance the vaults are AI powered, and the idea there is that there's about five AI agents that run on each vault, effectively plug into a multi-sig basically, and they have to, at least 3 of them at any one time, have to propose the same rebalancing strategy to actually move funds into the relevant vaults, and so on. So yeah, it's still in its early stages and so on, but yeah, there's a lot of kind of like improvements constantly being made to them. There's a lot of learnings going on there as well, but ultimately what we're seeing is that it's maximizing kind of market return, and so on there, that it isn't just trying to like stick to the most simple rule set around move X to Y if this, like there is trying to understand kind of like trends and forecastabilities and so on, like understanding what happens in the market. Sometimes when yield spikes, like for a low yield one suddenly spikes to a high yield, like that isn't necessarily the time always to get in, particularly if it has a history of spiking and then falling back down to one that maybe it wasn't allocated to before. So understanding those spikes and actually making sure we don't move money in and out. Again, when one might immediately drop, potentially a large borrow position has just been repaid on an underlying market, which has caused that kind of utilization curve to move right down. The APY may drop, but again, something's telling us then that the user was going to withdraw the collateral, for example, there. So actually, there'll be more cost to the users using it if you were to actually try and rebalance at that point. So keeping it in, using market dynamics, and actually we've actually got a new like intents-based system supported by the AI as well, kind of in a proof of concept stage right now as well, where protocols will actually be able to kind of like bid for some liquidity and so on to up the APY. And again, that's AI power to understand what the kind of rates need to be over certain periods of time, but that will allow users to capture more APY that isn't available in the market on there. So yeah, it's got AI. It's kind of at its earlier stages at the moment, but we've already seen it provide better returns.
Yeah, I would also say. Oh, sorry, Chris.
Like, go.
Interrupt you. I would also say, just like, although like this stuff can be extremely complex, the fact that it is on chain and transparent, like AI does give us a better ability to interpret, for sure, like the on-chain data, and it's certainly still at the nascent stages. But I think that that's like quite powerful. And so, you know, when you have the data at least out there, that's like a lot better than it, you know, to the earlier example, like shielded by a centralized entity that is compliant and has a regulatory, you know, department checking a bunch of irrelevant boxes. So, you know, data, if you put the hands of like the information in the people, I think it's overall like much better than, you know, the historical structures.
Yeah, I completely agree as well. Like, I think once users can understand a little bit more, and if they can use AI to understand what's happening, like if we think back to 21, like a lot of retail users got burned when a lot of the kind of wealthy DeFi natives or whatever like made a lot of money ultimately from retail, and we've never brought those like 21 retail users back yet. Still, like they still haven't come back on chain. They might be back in centralized exchanges or back in Coinbase or whatever. But yeah, they got burned hard. And if we can use AI to potentially help them, I think that's only beneficial. Like explaining the kind of like making it more transparent, because yeah, the blockchain, Ethereum, and so on, we talk about transparency, but a lot of the time it's just numbers and letters and so on, and like hexadecimals and things like that, right? To the user, and it's like, okay, it's transparent, but is it readable and understandable? And yeah, if AI can help make that, and we can build more tools to make it easier to understand, easier to use, then hopefully fewer people get burned. But yeah, there was also a lot of scam projects back then as well. And if AI can detect, like we can use AI to detect if it's a scam, or this contract has a kind of like a rug pull switch in it, basically like be careful, like that's going to be hugely beneficial, because
I'm guessing as well, like AI as kind of keepers per protocol has this cool side effect that even if at some point like the company that built the protocol kind of abandons it, it could actually still coast and continue along and be massively successful, right? Like we still have, I feel like a whole bunch of like vaults and tiny protocols like 5 or 6 years ago that still kind of have like 20 to 30 million worth of assets in there that no one ever bothered withdrawing, that right now just don't do anything right. Like maybe people even lost like the original private keys they used to manage the admin. But if indeed like you have some, it's like verifiable AI, so at least that you like anyone could run it, then you'd indeed see that these protocols just keep on operating forever and forever, right? So that you could indeed like put your money in a vault where the devs haven't looked at the vault at all for the last 10 years and still indeed generating revenue. So I guess that's quite a cool side effect of this architecture.
I like that.
Yeah.
You want to go like create some sort of agent to troll like the 2019, 2020 era contracts that are out there. It's a good idea.
Yeah, exactly.
Yeah, and I mean, you touched on it, you said like if the company goes down and so on, like the lazy vaults can continue to operate with like the AIs and so on. And yeah, I mean, the lazy summer protocol that's accessible for all the users on the Summerfi front end is completely decentralized and DAO driven as well. So there is no company behind it keeping it running. Like if the Summerfi keepers like need to be turned off one day, the DAO could just nominate, like put new keepers, like nominate another company to run the keepers, AI power keepers or whatever. So yeah, there's a huge opportunity there to just keep it going. Like you said, like there's a like still got like the RVV1 protocol and so on. There's probably still deposits in that, right? Although they can't make new deposits and so on, there's still deposits there, probably from lost keys and so on. And yeah, like
yeah. So guys, apologies for the listeners, but today we have to cut it a little bit shorter because I still have to hop onto an event. So to be honest, like extremely interesting conversation. You guys have been nerd sniped for a couple of times. I'd love to dive deeper into all of this stuff another time. But maybe now with indeed like crypto summer, a whole lot of new innovation. What are you two most optimistic about in like the next 6 months? What's making you wake up and get back at it and keep on building?
Yeah, I mean, I feel like it's stablecoin summer in the US. So that's really exciting. That's a space that we've been working in for a long time. But I think that, you know, when I started up Franklin 3 years ago, there were not a lot of crypto companies that were actually operating their businesses on chain. And we're seeing a lot more start to like do that. And so that's really what I'm pumped about. I think that like it's easier to move your balance sheet on chain. There are a lot more tools available to like run a big boy business. So that's kind of what we're pumped about.
Yeah, I mean, I think the stablecoins thing is 100%. I don't think it's just the US as well. I think it's kind of like the UK, Europe as well. Like stablecoins are the main chatter everywhere. For us, it's about adding yield to those. And yeah, it's starting to see kind of more real world adoption of DeFi and on-chain. For us, on-chain yield in particular, but yeah, just on-chain stablecoins, like managing things on chain, bringing the apps or bringing DeFi into the apps ordinary people use day to day already, because. Yeah, I think we're slowly starting to move in that direction. Maybe not 6 months, maybe probably more 12 to 18 months, but slowly starting to see kind of on-chain DeFi effectively move into the hands of people into their existing apps and so on. And I think like the likes of Robinhood and so on announcing the Robinhood chain and the tokenized stocks and so on, that's a good first step. But yeah, I think we're going to see more of that over the next 6 months.
Very cool. Yeah, for me personally, indeed, like it's the excitement around like a lot of builders who actually have indeed been building this type of stuff since 2021, where we had a little bit of a DeFi shakeout, some protocols going wrong, but now that like initial interest again to indeed build proper financial products truly returning. So Meg and Chris, thank you so much for hopping in and taking the time. Hoping that we can repeat this one in the next couple of months. And everyone listening in, thank you so much for getting a bit educated on the stable space and the real revenue space.
Thanks so much. It was fun.
Cool. Yeah, thank you. Really enjoyed it.
Thank you so much. All right, guys, have a good one and speak to you next week.